Okay, this is June 14's Unit 2 paper, question 3 about disposals. So pause the video and have a read of the scenario. Okay, so the first thing we're going to do is we're going to put these numbers in the T accounts. So the motor vans, the cost was 90, so that's going to go to the motor vans at cost. Motor vans is an asset, so it'll be on the debit side. So I have balance BD, which is £90,000. Depreciation, well, that'll be on my provision for depreciation, and provisions always credit because that's going to reduce the value of my asset. So my balance BD there is 30,000. Now the 60,000, that's net book value, that doesn't actually go in my TE accounts. Okay, during the year ended 31st December 2013, Andy purchased 3 motor vans in a part exchange arrangement with Robson Motors. The details are as followed. Andy purchased 3 new motor vehicles at a cost of £45,000. Okay, let's see how he got the 45,000. So he part exchanged 3 old motor vans that had originally cost 27,000 total and had net book value of 12,000. So what we need to do is we need to get rid of that 27,000 from my motor vans. So it's going to reduce the assets. It's going to go on the credit side. So I'm going to send it to my disposals account. So 27,000. And then what I do is on my disposals account, I put on the debit side because it came from the credit side. So motor vans and the cost 27,000. And it had a net book value of 12,000, so that means it's depreciated by 15,000. So I need to get rid of 15,000 depreciation. So here I'm going to send 15,000 depreciation to disposals. And again, the reason I'm doing that is because I'm getting rid of some of it. I'm getting rid of a car, a motor vehicle, so therefore some of the depreciation will disappear as well. And it's on the debit side, it's reducing my depreciation. So it'll go on the credit side. So provision, which is 12,000, 15,000, sorry. 12,000 was the net book value, wasn't it? Okay. And then when we look at that, we've got 27,000 on that side, 15,000 on that side. So it says he part exchanged 3 old vehicles, which cost 27,000, and that means that there's a £12,000 difference. So we need to work out how much he got for those vans. So we look at the third bullet point. It says he paid the balance on for the new motor vehicles with a check of 35,000. So that means he got £10,000 from it. Now I'm just going to put the working out here so you can see it. So the part exchange value, to work it out, well, the new vehicles are going to cost 45,000 and we still have to pay 35,000. So that means we got 10,000 part exchange. So my net book value was 12,000. I got 10,000 from it. So that means we made a £2,000 loss. So loss is how much I got. Take away my net book value. So my loss was £2,000. So it'll be an expense on the income statement. So the £10,000 is that we got is going to go on this side. So that's going to go to the motor vans, £10,000. And it's on the credit side because, and it comes from disposals. So it's on the credit side because on this account, this T account here in the motor vans, £10,000 is an increase in my asset. So that has to be the debit side, therefore it has to be the credit side on this one. Now, if you look, we know £2,000 has gone one side. So I look on this side, I've got 27,000. This side, I've got 25,000. So that means the 2,000 has to go on this side. And that makes sense because it's an expense. And it's going to get sent to the income statement. So now all we need to do is balance both sides. Why that's missed it out. So it should have went there. And then that's both sides done. So I'd underline them. Underline them on here. Oh, in fact, we can double underline. How clever is that? There we go. So we also paid 35,000 by check. So again, my motor vans has to increase by £45,000 in total. 10,000 come from the part exchange, from the disposals, and the other 35 is going to come from a check. So that means it's going to come from the bank. And if I had my bank account here, it would go on the credit side because there's money out of the bank, but I don't have a bank account on this one. It says it is Andy's policy to provide a full year's depreciation in the year of acquisition, so that just means the year of purchase, and none in the year of disposal. Depreciation is provided at a rate of 33 and a third percent, so it just means a third of the number per annum using the reducing balance method. So what we need to do now is we need to see what the current net book value of everything. So if I look at this side, so well, I can total this side. So I get 135,000. So therefore this side needs to be 135,000. So if you work out the difference, so 135,000 take away 27,000 gives us 108,000. So that's going to be my balance CD. On this side, my balance CD would be 108,000. So that's my cost value for my motor vehicles. And then I'm not going to balance this side yet because I still need this year's depreciation. But if you look at what we will get, 30,000 to take with the 15 that's gone, so it's 15,000. So my current net book value is 108,000, take away 15,000 for the depreciation, which is 93,000. And to get the depreciation, I'm going to do 33 and a third percent, which just means a third of 93,000, which is 31,000. So this year's depreciation will be 31,000. So that means it's going to reduce the asset even more. So it's going to go on the credit side, and it's going to be because of the income statement. So we said it was 31,000. Now I can balance it. So this side gives me 61,000. So this side should give me 61,000. So that means the difference there, 61 take away 15, is 46,000. And that's going to be my balance CD. So on this side, my balance CD is going to be 46,000. So I can pull that off. Okay, and that's just done. So again, just run through that last bit. We had to work out the current net book value. So I needed what my cost was now. So it was my 90,000 that I started with, plus my 45,000 that I've gained in motor vans, take away the 27,000 that's displayed. So that's where the 108 comes from. Then I needed what the depreciation was so far. So it was my current 30,000, but take away the 15,000 from the depreciation from the van that's left. So that left me 15,000. So taking away, that gets me a net book value of 93,000. Work out a third of that, which is 31,000. So that's how much depreciation there is this year. And then balance that account. So therefore I know my provision for depreciation is now 46. My total cost is now 108. So if I want to work out net book value, I'll just take those away, and that will be my new one, that will go on this year's SOP. 15 marks. And then the 1 mark at the end just says tick 1 box to show which of the concepts shown below has been applied in the treatment of depreciation. Well, depreciation has to happen yearly, so that means it's in the accruals, because otherwise, if I didn't have it yearly, if I just depreciated it when I sold it, that means it wouldn't depreciate equally each year. Not equally, it wouldn't depreciate each year. So it would be this one. This essentially makes no sense for this one. In realization, well, there's been no transaction apart from the sale of it. There's no transaction for depreciation.